Hi, this is Jinrong, Market Strategist for IG Singapore. Wall Street scaled to yet another fresh record high last week as a series of US economic data continue to put inflation concerns on the back burner while feeding into soft landing hopes. This comes amid some recalibration in Fed rate expectations, with a March rate cut currently being priced at a coin toss versus the 75% probability at the start of January. On another front, further monetary easing from China's central bank did trigger some unwinding in bearish bets for Chinese equities, but whether the recent move translates to a turnaround in economic conditions remains a question given the limited success in previous support measures. As we head into the new week, there are 4 things on our radar. First up, the upcoming week may be the busiest for US earnings season, with 5 out of the magnificent 7 stocks releasing their results. With the group doing much of the heavy lifting for market gains in 2023, all eyes will be on their upcoming earnings and forward guidance to justify the valuation they carry. Thus far, 14% of S&P 500 companies have released their results, with 85% delivering an earnings beat, which suggests that earnings recovery momentum remains intact. Next up, we have China's official PMI data out on Wednesday. Despite a series of policy support over the past year, China's PMI figure have not seen much of a turnaround. Market calls for more policy support were answered last week when the China Central Bank announced a larger than expected 50 basis point cut to its reserve requirement ratio and further measures for its property sector. That will leave market scoring for any improvement in economic data ahead as a reflection of policy success. Ahead, expectations are for China manufacturing PMI to stabilize at 49.2, while services PMI may improve to 50.6 from previous 50.4. Next, we have the US FOMC meeting outcome on Thursday. In December, the FOMC kept the Fed funds rate unchanged for the third straight meeting, while noting that economic growth has slowed, job gains have moderated, and inflation has eased. With the US rates market pricing in almost 170 basis points of rate cuts through 2024, validation will be sought from policymakers for such dovish pricing. At the upcoming meeting, the FOMC is expected to keep the Fed funds rate unchanged once again, but the statement is expected to be similar to the one in December, and will not signal that the start of a rate cutting cycle is imminent. Lastly, we have Eurozone's inflation data out on Thursday as well. Last week, the ECB has kept interest rate unchanged for the third straight meeting, but ECB President Christine Lagarde has tried to keep dovish expectations in check by stressing that any discussion on rate cuts are still premature, with markets leaning towards 6 quarter point cuts from the ECB through 2024, with the first cut being as early as April. Further progress on the inflation front will be on watch to provide support for such dovish pricing. Ahead, expectations are for headline CPI to ease to 2.7% year-on-year. The core aspect is expected to soften as well, with consensus for it to hit to 3.2% from previous 3.4%. That's all for now, and I will see you next week.